welcome to Nirmal Bang, ladies and gentlemen. I'm Hiral Dadia. We have with us Chakri Lokapriya, MD and CIO at TCG Asset Management, joining in. Welcome to the show, Chakri, and a pleasure to always speak to you and get insights from you. And this is the best time to speak to you as well, taking into consideration the way markets have been moving from here on.
Thank you so much for having me. It's always nice to come back on your show. I think these are very unprecedented times, and good to be a part of them.
Absolutely. So, Chakri, with the kind of levels that we are seeing in the markets, what's the sense that you're picking up? Because somewhere there has been a disconnect between what the stock markets are showing you versus what the economy has already shown you in the last 12 to 18 months.
I think the way, it's very clear that, over the last 12, 18 months, we've gone through a COVID, first wave, second wave. And as a result of that, there have been different kinds of, if you look at different kinds of beneficiaries and different sectors which have suffered as a result. Now, today, where we stand, and as the economy slowly unlocks, and hopefully COVID recedes, and in other words, there is no third wave. And as the unlock happens, there are two kinds of plays, and within that, there is a lot of sub-sector rotation. So, and I think that is what has been evident in the market over the last 12 to 18 months. The first beneficiaries, IT, metals, and then it moved on. So I think from that way, we're still a long way to go. There's enough rotation to happen.
Right. So currently, overall, if you go to see, is this the time to exercise caution? Or is it time to understand that we are indeed going through what could be called the mother of all bull markets?
I'd like to think we are in the mother of all bull markets. There will be corrections along the way. And I think there should be more, you should take them in stride. Clearly, when markets run up, they have to run down. And I think that will continue to happen. But I think we are in the middle of a bull market because we're in the middle of a bull market for earnings. Earnings are set to recover in the coming quarters. And this won't happen all at once. This will happen sector by sector, and which will give the opportunity for the market to move higher and higher. So as that happens, I think, you should just, have your seatbelts on and go for the ride.
Absolutely. I mean, that's something which really gives confidence. So overall, if you go to see, the global markets also have seen a major weakness. I think last couple of days, there has been a time when it was looking extremely terrible. And you had the domestic markets, which started the week around, say, levels of 17,450 as well. Now, surprisingly, after the initial hiccup, we did witness a V-shaped recovery, not only to erase losses, but also trade in the positive above 17,600. So taking all of this, what cues are you sensing from the global markets as well overall? Because a lot's happening over there with regards to where the liquidity issue is concerned, the way the bond markets are moving. China, you've seen what's happening with the power crisis as well as the real estate crisis that we're looking at. So all of this coupled together, do you think Indian markets are going to still associate to the global markets? Or do you think eventually our markets are going to be somewhere superior?
Those are all lots of very interesting points. I think, India is very unlikely to be superior and continue to outperform the other markets because it is the world as one big place. And what's helped Indian stock market over the last year and a half has been a global recovery ahead of the Indian recovery. If you look at sectors such as metals, information technology, pharmaceuticals, textiles, chemicals, many of the companies, for example, you take information technology as a sector, almost close to 100% of their revenue comes from outside India. You take pharmaceuticals and chemicals, roughly 40 to 50% is from outside India. So their fortunes are not dependent on India as much as a pure domestic sector, like let's say hotels or a multiplex. So what has happened is because of the huge fiscal measures that have been adopted around the world, mainly in the developed markets, which India serves, US, UK, Europe. Indian technology has been a beneficiary. Pharmaceutical has been a beneficiary, chemicals, and will continue to do so because, certain sectors have disproportionately benefited for the longer term. IT. What companies were thinking of doing over the next 2, 3, 5 years have, fast forward and crunched the whole thing in doing it now, moving to the cloud. And that creates an immense, if you rewind back to the year 2000, Y2K, 21 years ago, it created the same kind of a gold rush in terms for the Indian IT services. And I think we're in the beginning of another such gold rush for Indian IT companies and export companies.
Right. So overall, clearly, if you go to see with investors who are largely expecting the US Fed Reserve to kick off tapering by the year end, do you think that the domestic markets look set to enter a small mid-cycle transition where we could be vulnerable to a sell-off? However, probably that could be the time where one could again start investing and see an upcycle again.
This time the tapering was probably well known in the sense that last time when we had the problem 2013-14, at that time the markets were unsure how the Fed would react. But I think there has been a lot of lessons learned in communicating, and they're doing an excellent job, the Fed, in communicating and in the bond purchases that they have been doing. And on back of that, you have an excellently strong underlying economic recovery that is taking place in the US. And with that, it is lifting Europe and also like the pockets of India, which we discussed about, the various sectors, export sectors in India, which benefit. So this kind of an upcycle will continue. Will it create hiccups? Definitely yes. Should we be concerned about it? Absolutely not. Will it need course correction? I think absolutely yes, because the Indian market now is, and like other markets, the sector rotation is simply because of, see, for instance, until now we've had hotels closed, multiplexes closed, services industries largely locked down. As India unopens for these sectors, earnings will come back. And as earnings come back, the market will rotate away from some other sector and move into these sectors. So it is necessary to be cognizant of how the economy is meandering its way from one sector to the other before it turns into a full-fledged recovery across sectors. So I think for this whole cycle to unfold, we are still probably a good 18, 24 months away. Until then, I think it's an up market.
Right. So overall, even if we see mild corrections, what could the quantum of corrections be? Because there have been times, Chakri, where the corrections have been as deep as 15 to 20%. However, even if we see a 5 to 10% correction, is that something which could be a possibility from current levels? Or do you think we're still some time away from seeing mild corrections as well?
Mild corrections can, or severe ones, can happen at the drop of the hat. For some unknown reason, if they say that there's a third wave which is going to happen, then markets will correct. So we need to be cognizant of the fact that you will have the markets reacting to news that is not expected. In this case, we are expecting a third wave, but we're expecting it to be a mild one. If it turns out to be a severe one, then market will correct. So likewise, what happened in China with the real estate and the power crisis is what led to the corrections of last week. Now, so I think these are par for the course, and we are bound to expect it, and we need to be clearly aware of such corrections.
Okay, and overall, right now, if you see with the way markets are going, a lot of sectors in the last 18 months have seen that kind of up move. Now, what do you make of the value from a valuation perspective? Where would you place markets, and what's the actual valuation we should be looking at?
Okay, see, I think those are very good questions. Simply because if you look at the earnings itself, has not yet recovered. So if you look at the multiple, therefore, of a Nifty or any index, it's probably trading at about 22 to 23, 24 times. Now, is it a real multiple? No, simply because the in a price earnings, the price is real, the earnings is not real, as in it's not a normalized earnings yet. So right now we are still looking at the recovery phase. You take a hotel, you take a multiplex, you take the airline industry, you take even hospitals for that matter. Their earnings are still not normalized. So if you look back pre-pandemic, let's say you went back to 2017, when business was as usual, are we at that level in India? No. So by the time that happens, that's when we should look at PE multiples. Meanwhile, if you look at, you should look at individual sectors and individual stocks. If you take metals, metals have more than doubled from the bottom to now. After this, they're still trading at anywhere between 5 to 7 times EV/EBITDA multiple. Now, in a mid cycle, those are perfectly reasonable multiples. What you're saying is, look, I see myself a fairly decent horizon of the next 5-6 years. I see earnings coming through, and that's only 6 times. A company as large as Hindalco or Tata Steel, it takes longer than 6 years to build that company of that size. Whereas when you're paying 5 to 6 times EBITDA, what you're saying is, I'm going to buy you out for the next 5-6 years of your EBITDA. So which tells you that there's a lot more upside left in spite of several sectors and stocks doubling and tripling. That's the way we would approach it. So look at the sector, look at its valuation, look at individual stocks, where do they fit within that spectrum, and accordingly place your bets.
Right. So overall, from here on, do you think it's not the time to short but book profits at higher levels? Should this, be the advice?
Clearly, I wouldn't short. Shorting is always feasible with, shorting the overall index. I wouldn't do that. Shorting individual stocks, they will always find opportunities. Now, as far as booking profits, there's nothing like taking money off the table. So one should routinely do that. But then if one is doing that, then they should rotate back into the market. You book profits in one particular stock, then find another stock which there is sufficient room. Now, for instance, Coal India or ONGC, these are run a lot, but these are still trading at multi-year lows. Given the well-known reasons, they're government companies, etc., high regulation. But right now you have earnings in their favor. When earnings are in their favor and multiples are at historical lows, there's still sufficient upside left.
Right. So with all of this, Chakri, a couple of things that everyone is looking at is, how is growth going to pan out? How will inflation pan out? You already mentioned that if there is a third wave or not. Now, all of these factors have actually not really translated into reality as such. Now, if there is a correction, we mentioned that yes, if there is a third wave, we could see a correction. But apart from a third wave, are you fearing any other factors which could cause a correction in the markets?
So these are times when both corporates as well as governments, regulators, need to be very cognizant and not introduce any new taxes, make any retroactive adjustments. And I think those are very, very vital things. For instance, just removing those retroactive taxes did wonders to the telecom industry. And after that, you saw that Bharti Airtel come up with a new offering, the rights offer. So it's like that. If you make the right move, it will be followed by another right move by the industry. For instance, gas pricing. Gas prices are at multi-year highs globally. In India, gas prices are reset every 2 years. Now, that is clearly, fortunately, the powers to be recognized, and they're thinking of changing that format. So I think that should be in whatever the government, regulator, companies need to do, and we as investors need to watch whether the steps taken are incremental. Then great. If they're big bang positive, great. But the flip side also holds, which is you need to be worried of.
Right. So overall, right now, if you have to see in terms of sectors, where are you seeing a lot of value and growth that could be coming in?
If you look at IT, the earnings is very strong, growth is very strong. And still yet, tomorrow when TCS reports its earnings, there will be another big round of earnings upgrades. So we're not talking stock market returns, we're talking just profit upgrades. So which means suddenly the multiples for the whole sector will start looking reasonable again. So as long as the earnings momentum, business momentum continues, which is evident in a number of sectors, export facing ones, IT, chemicals, I think you'll continue to see. Now, in terms of pure value, it is probably banking.
Right. So, I was going to come with banking as well. Now, banking as a sector has not really performed in line. They're still being laggards. So, do you think it's just a matter of time before they catch up? And therefore, there will be opportunity, and it's going to be the financials that are going to actually now support the mother of bull run that we're talking about?
You used the mother of all bull runs. I think that's very important to recognize that we do. Financials is the single largest, biggest sector in an index. And that sector has underperformed the index itself, largely because of a couple of reasons. If you rewind back pre-pandemic, and if you rewind back even a good 5 years ago, it was the credit growth of the nation, credit growth of, that is borrowing by the government, borrowing by companies, borrowing by individuals. When you and I go out and spend in a supermarket, buy a car, buy a bike, buy a house, that is consumer spending. Government spending on roads, bridges, dams, government spending, and companies building new factories is corporate spending. Now, this was in the region of 25 to 30% annual growth about 5-7 years ago. That growth has now come down close to about only 3 or 4%. Now, can you believe that? Which means a consumer or a corporate or a government is borrowing far, far, far less, a fraction of what they did a few years ago. And why are they doing that? A consumer is just still coming out, recovering from the shock of the last 1.5 years, not sure where of their income, and therefore spent less. But with now salary revisions coming across sectors, they will get the confidence back to go out and start re-spending, credit cards, home loans. Now, companies, exactly the same story. They were sitting with very low utilization levels. And now if you look at a factory, they're running only 60-70% capacity. So there's no real need to go out and set up a new factory. So as those utilizations level move up, there will be again a credit growth. And third, the government has to go out and start rebuilding the roads, bridges, because you had migrant workers going away, various reasons which led to a slowdown. When all these things come back one by one, it's probably the consumer comes back first, government follows, and then only after that the corporate. Will the credit growth rate of banks, that is, which is right now probably about 2 or 3%, as that number accelerates, investors will rotate back into the financial services sector.
Right. So with this kind of rotation, if the market's correct, do you think it's time to reopen themes from hotels, cinemas, aviation? Because these are sectors which are now starting to see a revival as well. So is this the best time to look at them?
I think you're absolutely right. If you look at companies like Thomas Cook, these guys own the Sterling resorts across the country. You have Mahindra Holidays, they're again resorts. Now, then you have the Lemon Trees, Chalet, which owns the Marriott Hotels, Indian Hotels, which is a Taj brand. So across various price points, Sterling on one hand, Mahindra Holidays at one level to the Tajes of the world. Now, there is some amount of revenge travel which will come back. I've been sitting at home way too long. Now I'm vaccinated. I will go out and have a holiday. And I will go out and spend and buy that dress because anyway, Diwali is around the corner. Now, this is not yet translated into earnings. And we have a number of things between here and the new year. You have the Navratri, Diwali, Christmas, then early next year, festivals, harvest festivals. So I think with all this, I think these are good stocks and sectors to invest in.
Right. And apart from these sectors, what's the view in terms of commodities and in turn metals? Because metals have seen a major rally in the form of commodities, and simultaneously it's percolated in terms of stocks as well. So, do you think this up move is here to stay, or now it's the time to book profits with regards to metals?
Now, if you look at them one by one, if you look at metals, metals in the US will probably pass, the showdown in their Congress is probably going to be tapered down, and a good sense will prevail. So, which means when bills pass, then you're going to have a good amount of a demand uptick for metals. Right now, they are in phenomenal short supply. If you look at aluminum, steel, all of them. And if you look at waiting lists, people going and booking cars, unheard of. And so, which means the demand to make you need aluminum to make a car, and therefore the demand for a car is strong. Therefore, demand for aluminum will remain strong. Now, this cycle is likely to continue for a fair bit. We still have a good several quarters more, and the valuations are still on the side. Then you look at commodities. You take iron ore, again needed to make steel, in short supply. Coal to run your factories, again in short supply, because last year was a lockdown. This year is an unlock. And as companies are moving from this to unlock, from lock to unlock, there are supply chain issues. Still ports, aircraft, all these things have not normalized. That has created a transitory inflation, but for it to normalize will take time. Demand is growing. So I think these sectors will continue to do very well.
Right. And with regards to where the export-oriented plays go, especially pharma and IT, any topics on that front? Because clearly, if you go to see the US-China trade war, that's something which did give us a competitive advantage as well. And India had to now leverage its strengths sector by sector. So taking this advantage position into consideration, what would your recommendations be?
IT, I think, is in a phenomenal place. If you look at the kind of salary hikes that IT employees are getting, north of 15, 25%, and still there are 2 or 3 job offers. And that's always a great sign, because it puts which means that there's more than sufficient demand out there for companies to pay that kind of a salary increases to get employees in. And this is happening because of the move to the cloud and the move to various advances in the software and in the technology areas in the advanced world has created for some companies, the services companies need to implement those software and those services. So the implementation demand for the Indian IT companies, so whether HCL Technologies, Infosys, Mindtree, they continue to look very strong. Chemical companies, again, one is the basket of products that they're producing has tremendously improved over the last few years. And therefore, they are in demand not just from one country, but from multiple countries, there is a demand. And meanwhile, not just the range of products, but there's also been a certain amount of backward integration within India of the part of the Atmanirbhar and schemes. And so I think their runway still looks very good. And then, the domestic sectors have to unlock now. We discussed hotels, we discussed airlines, etc. And one by one, they will come back. So I think while there will be corrections, it's not time to shy away, but rather invest in the markets.
Right. So these are sectors we should look at. Now, very lastly, Chakri, Indian markets in terms of valuations, we've spoken. Corporate results so far have started showing resilience. We are seeing an uptrend. Taking into consideration that the third wave does not come in, COVID cases drop, and ample money flow continues, where will you see Nifty after 6 months? Do you assume it will be 15,000 or 20,000?
I'm a positive guy to think or to begin with, and I think more it's 20, or rather, actually, probably 22,000. Because if you say, let's say that you're going to have a 15 to 20% increase, so that translates to roughly this 20 to 22,000 kind of a level. And I think that's where we are headed. Now is the time to go ahead, invest, be mindful clearly, but please be invested in the markets.
Absolutely. Continue to stay invested in the market. And these are times, Chakri, you need, optimism as well, apart from pessimism, because the moment the markets reach these highs, that's when the pessimism starts to flow in, whether markets are going to correct or not. And that's when investors start taking wrong decisions. But thank you so much for your advice and insights. Always a pleasure to have you on the show and speak to you. Thank you. Stay safe and speak to you soon again.
Thank you so much. Thank you for having me.